Direct, engaging Minda commands a market capitalization of over 74,000 crore rupees. It currently trades at a significant price-to-earnings premium compared to its peers in the auto ancillary industry. To understand why investors are paying this price, we have to look at the underlying architecture of their business. The company defines itself as powertrain agnostic. This means they manufacture and supply components that are used in traditional internal combustion engines, as well as the emerging electric vehicle market. They also maintain highly diversified revenue streams, ensuring they aren't dependent on any single component or vehicle segment. This is the revenue mix for fiscal year 2026. Switching systems lead at 25%, followed by lighting at 23%, and castings at 19%. The rest is split between seating, acoustics, and a category labeled Others, which houses their sensors and EV powertrains. That 22% slice is the fastest growing part of the portfolio, as content per vehicle increases in the EV and ADAS segments. By remaining powertrain agnostic, Minda hedges against the risk of EVs displacing traditional components. Because they supply both platforms, their business model is structured to capture market share regardless of how quickly the transition happens. That market share is defended by a series of global joint ventures and deep technical integrations directly with original equipment manufacturers. Their total addressable market is expanding due to two simultaneous trends: rising EV penetration and vehicle premiumization, where consumers demand more expensive lighting and electronic systems. Management has issued a 5-year growth guidance with a specific commitment to maintaining EBITDA margins at 11%, with a variance of 50 basis points. To support this expansion, they are scaling capacity, including a new passenger vehicle seating plant scheduled for commercial production in the second quarter of fiscal 2028. The company has already secured a significant order book for EV systems, which provides a long-term revenue stream as these projects go into production. While supplying OEMs involves concentration risk, Minda spreads its exposure across both the two-wheeler and four-wheeler markets. Within that mix, Maruti Suzuki serves as a consistent anchor client, providing high-volume demand stability. This combination of a secured EV order book and anchor clients creates high revenue visibility, which provides a more predictable long-term outlook for equity investors. To see how this strategy is performing, we have to analyze the hard numbers from the Q1 fiscal 2027 results. This quarterly report shows record consolidated revenue of 5,557 crore rupees, marking a 26% increase year over year. Profit after tax followed a similar trend, growing 24% to reach 296 crore rupees for the quarter. A major driver of this growth was the 130% surge specifically in EV system sales compared to the previous year. However, there is a friction point in these results. Despite the record revenue, operational margins narrowed. The EBITDA margin compressed from 10.7% a year ago to 10.3% in the current quarter. Management points to specific macroeconomic pressures for this dip, including commodity price inflation, higher gas costs, and wage revisions across manufacturing states. While Minda is maintaining high double-digit revenue growth, this quarter demonstrates that even scale doesn't exempt them from global supply chain inflation affecting the bottom line. Moving beyond the quarter, the company's multi-year performance shows a consistent revenue and profit CAGR of roughly 24 to 26%. Their capital allocation efficiency remains high. Return on equity is 18.8%, while return on capital employed stands at 19%. Their leverage remains low, with a debt-to-equity ratio of 0.31, and they have maintained a consistent schedule of debt reduction. While the stock trades at an EV to EBITDA premium, the ratio of cash flow from operations to profit after tax remains healthy, even with the current heavy investment in new capacity. Looking at working capital efficiency, the inventory turnover ratio is 12.57 times. Although debtor days are stable, the overall working capital cycle is less optimized than industry leaders of this size, meaning more capital is tied up in inventory. Reviewing the internal metrics shows several indicators of a stable structure: a high promoter holding of 68.36%, zero pledging of those shares, and auditor fees that align with industry norms. The company's financial foundation is supported by these structural green flags, even if the working capital cycle currently limits how quickly that cash can be redeployed. To see if the stock's high price tag is sustainable, we need to compare it to other major players in the sector. Minda has a price-to-earnings ratio of 76.5. This is significantly higher than the industry average, which currently sits around 38. When contrasted with market leaders like Motherson and Bosch, Minda trades at a distinct premium. Even accounting for their high growth rate, the PEG ratio stands at 3.8, suggesting the current valuation remains high on a relative basis. The price-to-book value is 12.85, supported by a return on assets of 9.19%. Despite these multiples, the stock has consistently outperformed the Sensex benchmark over the past year. The market is currently pricing in sustained, high-level execution. Because the valuation is stretched, any future deviation from management's growth targets will likely have a pronounced impact on the share price. Beyond the fundamentals, technical analysis reveals how institutional capital is interacting with the stock price. The one-year chart shows a bullish channel of higher highs and higher lows. At 1,285 rupees, it trades in the upper half of its 52-week range. The 20, 50, and 150-day moving averages curve upward below the price, providing baseline support. On this chart, previous resistance levels have flicked into support, reinforcing the current momentum. The technical momentum reflects the fundamental growth story, indicating that buyers are still entering the stock despite the high multiples. The question for an investor is whether the current price reflects the company's actual intrinsic value. At 78 times earnings, the market has factored in significant future growth. This means the stock is trading well above its current baseline intrinsic value. However, given the 19% return on capital employed and the existing EV order book, an earnings growth between 15 and 20% remains a probable outcome over the next 5 years. Because valuations are at a premium, this is a candidate for a buy on dips or hold strategy. Entering with a large lump sum at these levels carries higher risk. A staggered accumulation strategy allows an investor to build a position in Minda's growth while managing the risks associated with its current premium valuation.